Now let's analyze the financial statements of Nortan. So we are given the financial statements for 2017 and the comparative figures for 2016. Now, since your exam is in February, bear in mind that these financial statements for 2017 may not have been approved as yet, right? Since it's only just a month and a half after the year end. And of course, your scenario can be from plus minus 6 to 7 months from February. So you can even expect your first scenario to be from somewhere around, I don't know, August, for example, right? Which means by that time the statements may have been approved, but the way that this is given, and if you are being tested on a scenario from February, there's a good chance that the accounts or the statements are still being finalized by the directors. So within that time period, there are certain events that occur which you may be adjusting in the statements, right? So this was covered in IAS 10, events after the reporting period. Now it's not directly a part of the F2 syllabus since it was tested for F1, although your examiner may test you on certain key areas from your last level, right? A few standards like IAS 16, 38 and so on. So looking at the SOPL, sales revenue seems to have increased. So 6853,5794. So that's an increase of roughly around 18%. And cost of sales also has increased by a large amount, possibly much higher than the increase in sales. And cost of sales has increased by 48.7%. That's a very large increase. So the reason for this might have been selling price of petrol and other items being reduced. We know that the demand for clean energy is increasing, right? So little by little the demand for fossil fuel based and petrol, diesel and all, they might be declining, and maybe a matter of time until the world purely switches to alternative sources. So anyway, we see that there's a reduction, there's an increase in sales and a much larger increase in cost of sales, possibly because we might have sold more liters but maybe at a lower selling price. Exploration expenses have reduced, so possibly because they did not carry out many projects within this year in terms of exploring new areas for exploitation. So that would have been the reason for the sharp drop. Pre-license exploration cost logically would decrease because the amount that we spent on exploration has decreased. Now this profit on disposal is of course a one-off transaction, and it's not considered as something that happens within the day-to-day operations. So when we are calculating our operating profit margin, it's ideal if we keep these figures out, the profit from disposal. So on both years we have made a very large profit on disposal from assets, right? So after if you are looking at the sales figure, well, this makes up quite a considerable proportion of the sales figure itself. So this might have been a large group of assets. Now bear in mind that this might be also the average of all the assets that were sold, maybe the profits and losses all summed up together. Then you have general and administration costs, which is pretty much the same from last year to this year. So although our volume may have increased, it seems like our administration cost, we have managed it well. Now surprisingly, nothing given about selling and distribution expenses, because they might have to do some advertising, certain transportation facilities are required, and surprisingly we do not see selling and distribution expenses in this. We have the operating profit, which has seen a very large drop from 2.9 billion to almost 2 billion, right? So that's a sharp decrease, but bear in mind that this is partly due to the profit on disposal being almost 1/3 of the value in the previous year. So if you look at the profit before taking into account the profit on disposal, so for 2016 it would be 2939.9, this figure, minus the 1641.3, which is 1298.6, 1298.6. And for 2017, you take the operating profit given and you deduct the profit on disposal, giving you 1401.5. That's 1401.5. So operating profit has increased purely looking at operational activities. Why I'm saying that is, as I mentioned, profit on disposal is not exactly a day-to-day operational activity. It's more of an exceptional item. So skipping that, we see that we have an increase. We have recorded an increase in our operating profit. But to say whether this is really good or not, we need to look at the capital employed and other factors. Finance cost has, of course, reduced. Maybe our borrowings would have reduced, or maybe the interest rate of the country would have come down. And this is a consolidated statement, so we have companies in so many different countries. So all their finance cost changes will have an impact on the total, of course. Then the tax has reduced, logically so, because the profit before tax has seen a sharp drop. And finally, the profit after tax has also reduced compared to last year. So taking a look at the SOFP. We have the comparatives given for 2016 and the latest statement as mentioned earlier. So intangible exploration and evaluation assets. So these are possibly purchased assets, and the only asset that would have been internally generated would be development cost, if any, which is of course governed by IAS 38. But apart from that, the license and so on, the licenses and so on would generally fall into the intangible assets category. So we see a slight increase. Property, plant and equipment has also increased. Now mind you, this is the net book value given to you. So if the net book value has increased, that means the additions to non-current assets have it's much higher compared to the disposal and depreciation. So we see that the company has invested quite a considerable amount for PP&E, which means they might have expansion plans into the future, and the best use of these assets are yet to come, possibly. The goodwill has remained the same, so this may be an indication that we have not purchased any new businesses within 2017, unless the only other possibility might be they would have bought some companies, and some of the companies they hold might have got sold, and the transactions happened in such a way that the amount of goodwill increased and reduced, but finally settled at the last year's balance, which seems quite unlikely, but of course it is a possibility. So unless that's the case, we can safely assume that we have not purchased any companies within 2017. Or even if we purchase, sometimes if we pay a lower amount than the purchase price, which we refer to as negative goodwill, in that case it will be shown in the SOPA. Then looking at current assets, the inventory levels have increased, although inventory levels are not quite significant compared to the other assets. Trade and other receivables have also increased. So trade and other receivables, of course, is a considerable amount. So this might be a little too long or a little too much, right? So Nortan could perhaps look at renegotiating their credit period so that they get the money back fast from the trade receivables. Cash and cash equivalents, it has almost tripled from 2016 balance to 2017 balance. Now the funny part here is we already have a long-term debt of 1.5 billion. So having a long-term debt of 1.5 billion, the question is, why cannot we use the cash in our hand to settle this? So one possible reason might be the interest rates of the country are much lower, or maybe we got some loans at a very preferential interest rate, and rather than paying them back, it would be much beneficial for us to use our money for further investments. The share capital and share premium remains the same. Then another very important figure, the goodwill on acquisition. Inventories. So inventory level, the trade receivables figure has increased. Now, being an international company with possibly many foreign subsidiaries, foreign currency reserve would play a major role in our consolidated financial statements. So, as you are aware, in your F2 syllabus, you have consolidation of foreign subsidiaries, which means there would be a foreign currency adjustment on the translation of assets, net assets, as well as goodwill. So it's important for you to go through this area from your F2 notes, where when you look at net assets, for example, the last year's balance should be at the opening rate, the closing balance should be at the closing rate, and the movement, the profits should be at the average rate, which means there will be a foreign exchange or translation difference. As well as for goodwill, where the opening balance again at the opening rate, closing balance at the closing rate, and any impairment would be of course at the average rate, and there too there would be a foreign exchange difference. So this has to be accounted for in the foreign currency reserve. Now we have retained earnings. The balance has increased clearly due to the profit. So let's see whether they have paid a dividends. So the opening balance is 6270.1, and we made a profit after tax of 1275 for the latest financial year, and the closing balance comes to 7052.2. So roughly around 492.9 seems to be a dividend payment, although this can vary with the foreign currency differences. So since the SOCIE is not given to us, we are not exactly sure of the total amount paid as dividends. But with the given figures and assuming foreign exchange rates are not greatly different, something like 492.9 is the dividends. Long-term debt has not increased. It's constant at 1.5 billion, but we see that the finance cost has increased from it has decreased rather from 216 to 198. So this 1.5 billion may not be a constant balance, right? We would have paid certain amounts and then again borrowed close to the financial year. This may be the reason why the finance cost is low. And a very important item, long-term provisions. Given the nature of this industry, when you obtain license for exploration or rather exploitation, right, drilling of oil, you need to pay, or you need to create a provision to restore these oil sites back to the original state. And if the license is for something like 10 years, right, anything more than 1 year, it is important for us to create a long-term provision. And in creating a provision, it's important for us to know about the conditions that have to be fulfilled. So there should be a present obligation because of a past event. So the moment you obtain a license, there might be a condition in the license stating we have to restore them. And of course it's probable, which means we have to get it done for sure, and we can come up with a certain estimate, although it might not be highly accurate because we are looking at a long time ahead. But there's a difference between the words accurate and reliable. So the standard clearly says it just has to be a reliable estimate. Then we have trade and other payables showing a slight increase, tax showing a reduction due to the reduction in profits, and we have some provisions, short-term provisions within the next 1 year. Not a large difference, 105 to 120. So let's go on to see the ratios calculated for the financial statements for 2017 and 16. Gross profit ratio, gross profit margin has come down. Possibly, as I mentioned, the prices of oil might have reduced and the cost of sales has also increased sharply. The operating profit margin has also reduced due to the same reason. And mind you, I calculated the operating profit without considering the profit on disposal, which is of course the right treatment or the right way to calculate operating profit margin specified in your F2 syllabus. Return on capital employed has also reduced. We have increased our asset base, right? Our equity has increased, and the loan amount of course has been stable, and the reduction in ROCE is again clearly due to the reduction in profits. And this is the same scenario with return on assets as well as return on equity. So return on assets considers the non-current asset base, and return on equity simply considers the equity figure. Current ratio has gone from 0.79 to 1.56. So that's a sharp increase. So we are not exactly sure about the norm of the industry, but the general norm is 2:1, and that is not something you need to take too seriously because it actually depends on the industry. And same thing with quick ratio. So possibly due to the increase in trade and other receivables, and of course the cash and cash equivalents almost being 3 times higher, this would have caused the current and quick ratio to increase. Receivable days have also slightly increased, which is not overly troubling. Payable days have reduced from 215 to 152. So this is possibly because our creditors are requesting for a shorter credit period, or it may even be because we are paying them back fast on our own to maybe grab some early payment discounts. Inventory days have remained stable proportionately. The working capital cycle has of course come down, mainly due to the reduction in payable days. Asset turnover is pretty much the same, right? So asset turnover represents the sales as a percentage of the capital employed or the asset base. So although asset turnover is similar, we see that there's a drop in ROCE, and that is purely due to the profit margins coming down. So our business continues to generate revenue, although our profitability needs to be focused on. Gearing ratio has slightly reduced because our equity has increased while the non-current liabilities or the long-term loans have remained constant. So the gearing is low, which pretty much shows a low risk capital structure. So gearing calculated in both ways, a 2% reduction. Then interest cover ratio has come down, and this is not due to our profits increasing but simply due to the finance cost reducing. So we should not take this too favorably. Then moving on back to the financial statements, on the next page we have segmental analysis. So in line with of course IFRS 8. So we have 4 areas, 4 regions that has segmental information given. Now there are some conditions to be met in IFRS 8 with regards to operating segments, right? So what decides an operating segment? You know, the 10% rule for revenues, assets, profits, losses, and so on, something you need to go through. So as you see here, the revenue of North and South Atlantic has increased. Middle East revenue has come down, whereas Asia, it shows a very large increase, but the operating profit is again a concern, because in North and South Atlantic, despite the revenue increasing, the profits have come down. Middle East also the profit has come down, and of course there's a reduction in revenue. Asia, it has not proportionately grown in line with the revenue, and to help you understand this further, I have looked at segmental ratio analysis. So there you go. So I have calculated 3 figures from the information given. So operating profit as a percentage of revenue, that's operating profit margin. Then profit as a percentage of assets, something we can call return on assets. And of course revenue as a percentage of assets, which is asset turnover. So operating profit margin from 2016 to 2017 has sharply dropped in North and South Atlantic. The return on assets has also dropped due to the declining profitability, although the asset turnover has increased. So not only for the overall business, but even for specific segments, we see the same story. And looking at Middle East and Asia, Middle East also, with the reduction in revenue, we see that the asset turnover has reduced, and also the profits have reduced. So it's highly concerning rather. Asia, although the asset turnover is very much higher, the profit margins are much lower, as I mentioned earlier, right? And of course the return on assets are higher because the amount invested is not very high comparative to last year. But this decline in profitability is an issue that they need to focus on and address quickly. They need to understand the exact reason for this. Then we have some notes given. The intangible exploration and evaluation assets. So we see that there is an exchange movement of 33.2, as I mentioned earlier. The additions are much higher than the amortization, and of course disposals combined together, well, it's not much higher, rather it's slightly higher, because when you add up the amortization and disposals, it will amount to 1196.7. so just a slightly higher figure for additions. Property, plant and equipment also, as I mentioned, the amount that we have invested seems to be higher, right? So overall, and then there's one more note about long-term provisions, which I explained to you clearly. Long-term provisions comprise the commitments made by Nortan to restore drilling and exploration sites to their original state upon the completion of work. So overall, the liquidity of the business does not seem too bad, right? Although the amount of receivables seem to have increased, right? And this high cash balance is somewhat concerning. Maybe they have bigger plans for the next year, where they are planning to finance it with their own money or internal funding, rather than going for loans and issuing more shares. But the profitability is the major concern here, because although operating profit as a total has increased, if you skip the profit on disposal, the profit margins have shown a very sharp decline, both overall and also in segments, right? All 4 segments that were reported shows a drop in the profit margin. So as I mentioned earlier, the prices of oil can be very volatile, and the trend is such that oil prices can keep reducing, right? So possibly Nortan may have to look at other areas also, rather than purely focusing on petroleum. And they could even look at clean energy sources, where there's a market growing, right? So all in all, that would be the summary of your financial statement.